So, ladies and gentlemen, today we'll be talking about leveraging. What is leveraging? As I've been actually studying online through Coursera about financial markets. So, I just sort of sharing some knowledge because it's imperative to share knowledge when it comes to anything in life. That's how you prosper and spread positivity. So, when it comes to leveraging, now, let's say, yeah, imagine a company or an individual borrows money to buy assets, and let's say that person or company is leveraging because you're putting more money into the asset than you have. So, you could buy, let's say, you have invested $100 to invest, but you could buy like $100 of stocks, or you could just buy $200 of stocks and borrow $100. So, this makes you in a riskier situation, as it is both up because it goes up and down, like how the stock market is. It is highly volatile, and it's imperative to keep a check on your investment so that you don't lose the money, or you don't go bankrupt. Now, let's say, like, if you bought $100 worth of stocks and you're lucky, when it doubles in value to $200, you've made $100 profit. But if you leveraged and the stock doubles in value, your portfolio goes from a deduction of 200 minus 100 to 400 minus 100, which is $300. Therefore, you have doubled your profits. And if on the other side, the stock falls in value, suppose you bought it unleveraged and you bought $100 worth of stock and it falls in value by 50%, then you're down by $50. So you have lost $50 over here. Now you're worth $100 of stock, which is 50% of what you invested, which was $200. So let's say, like, all of that wipes out, which I just mentioned before. Then you would go bankrupt, which you don't want, in the first place. So what leveraging does, it increases the probability, but it also has a reverse factor to it. So let's take a example of a country over here. Let's say, like, China. China. Okay. So China is widely described as a highly leveraged country. It has gotten worse, financially, day by day, due to financial crisis, and just recently because of a coronavirus. Now, there was a Wall Street Journal just the other day which therefore pointed out that corporate debt, borrowing debt by corporations in China, was a major impact when it comes to its financial crisis. It is 160% of the GDP in China, whereas in the US it's only 70%. This is the distinctiveness what we are looking at over here. So that means, like, the Chinese economy is leveraged and it could further do very well as a leveraged economy, but it's more vulnerable, and this is a major concern. So debt leads to bankruptcy, as I mentioned before, which you can just predominantly see it over here. Now, let's say, like, China over here doesn't do this, doesn't lend money from banks. So how would the economy then grow? So that is also one aspect to look at over here. So unless you end up using up all your savings, no steady income is made. That is just, that goes without saying over here. Furthermore, Professor Schiller, who is teaching your financial markets on this website, keeps coming back to Irving Fisher, who is like the author. Now, he's a little bit biased when it comes to like he's also a professor at Yale University, and Professor Schiller has never met this guy, like he's quoting over here. You know what I'm saying? So and he's he's like a kind of an idiosyncratic guy, very unorthodox in many aspects. Now he teaches about leveraging in a wider spectrum over here. He thought that it was uh, in like it was quite predominant when during the Great Depression that prices were falling at a rapid rate because of the depression, and there was a huge deflation. He was correlating depression, deflation with how it impacted when you started leveraging. So normally people who borrow money are kind of optimists. You know, like when you try to borrow money and you wanna invest, or when you try to also leverage, you kind of, you know, like you have the optimistic approach. But they assume that the stock market will go up. You know, the people who are leveraging over here, they feel that the stock market would go up, but uh, in certain times like the Great Depression or the recession in 2008, anything can happen. So risk needs to be well averse over here, and you don't want to take chances on the lenders, you know. So what does usually happen when there's a huge deflation and the consumer price index goes down? Well, it magnifies the real value of the debt, right? And if you owe $100 and the consumer price index falls by 25%, let's say, so your debt has gone up by 133. So it's gonna enormously henceforth start ensuing its deflation. Now, ensuing over here means it starts developing deflation. So therefore, debtors are wiped out. They're like knocked out. The optimists have less wealth in real terms, and the pessimists have more because now the $100 that they loaned is worth a lot more. So he thought it is more imperative, as we know, like people have the flair of being optimistic, whereas some people are just pessimistic and just sadist, you know, when it comes to anything in life, just let alone investing. So this means that that it is irrelative to have expectations. If wealth needs to be redistributed from those who borrowed money to those who lend money. So it's still true, and it's an important factor to consider whilst lending money or leveraging. I actually deviated over here with lending money also because it's a key, like it's a factor when it comes to leveraging also. So why not, you know, like why not give emphasize to it. Okay, so that's more than it on leveraging and also lending. Bye, have a nice day.